Good morning, friends. Thank you all for joining us on this webinar on the topic Solitaire Value Delivered. It's been 2 years since we began this journey, or more precisely 2 years and 5 months. Solitaire has gone through a lot of interesting times. First, we had the COVID crisis, and then we had this expansionary phase when global liquidity was sloshing all over. And then we have had a war, and we are also seeing the birth of a phase of rising inflation. So in that sense, we could have asked for a better time to start a product and to grow it, because it gives you enormous experiences, it gives you enormous challenges and enormous opportunities. So it's always a problem of plenty on all sides. So in that sense, we have had a very interesting journey, and this journey has prepared us much better for the future than we could have ever imagined. And in the process of this learning and startup phase, I believe that reasonable value has been delivered. Now let's look at the indices over a long period of time, because when you see 2 years, you think everything went up or went down. But over a long period of time, markets keep going up. The short phases of volatility, which we see over 2-3 years, tend to become small moves in this long curve or the big graph. So the big picture is certainly growth oriented. India as an economy and our market as a platform have tremendous headroom for growth. We still are yet to see ample penetration of our domestic service economy in the stock market. They're still with the private equities or with VCs. So over the next few decades, we are going to see better representation of economic growth in the stock market. And naturally, that would provide enormous opportunities to invest in for us. Over the past few years, we have seen a lot of volatility in every part of the market. Profiting from that volatility has also been possible. But remember that investing should always transcend volatility, because you should not get out when it becomes very fearful or it becomes too hot to handle. And you normally cannot get in at the right time when there is too much fear, though ideally we would like to do everything perfectly. So the most idealistic or the best probable approach would be to stay invested and to grow your investing during these phases of extreme volatility. And my experience is that even if an investor does 10% more than what he has already done during these difficult phases, I think that his returns are going to be way beyond what his reasonable expectations are. You need not speculate, you need not do crazy things, and you can still do a decent job of your investing. That brings us to the scenarios that we are now heading towards. Firstly, to the global scenario. If you look at the global macros, I think that the world economy is again going towards a slow growth phase. You are going to see rising inflation, and managing it is going to be sticky. Interest rates are going to go up. America is taking the lead. And you are also seeing rising geopolitical risks. The next fear is, what will China do in Taiwan? And we are going to keep on thinking about who will do what next. Our domestic macros are relatively stable. We are quite certain we are going to grow. We can debate whether our growth will be 7.5% or 9%, but we are going to grow, which is a rarity in these times. Inflation is our biggest enemy. It's rising, and controlling it is going to be tough. It's quite normal for those who have seen past cycles to worry whether this phase will become like 2012, and we can only hope it won't, and we'll have all the answers. But the good thing is that we have a fairly well coordinated effort between the Reserve Bank of India and the government, unlike in the past. So I think that the coordination will definitely help us handle an adversity much better. Interest rates are still accommodative, but it is inevitable that interest rates will rise this year. So that is how we see the Indian macro. As far as the market context is concerned, the global market has seen very high volatility. Russia is shut. China has fallen in the best of businesses. The Nasdaq is down much more at the broader market level than the headline number indicates. The Russell 2000, which is America's small cap index, has had a bloodbath over the last 6-7 months. But we can't really say that our markets have had that kind of reactivity. In fact, corporate balance sheets remain strong in our market. Results are more or less, meeting or just falling short of expectations. Our profitability, which is your margining, has been good till now at a broader market level. We are seeing pockets of valuation. I think that the polarity in the market, where the market is very heavily concentrated towards one section, has also thrown up a lot of opportunities in the ignored parts of the market. And as you see these kind of event-led changes in the economy, these value parts will get more bought into, and they will give a sharp bump whenever things normalize. So that's what we saw in tech in 2021, and you'll see it probably in other places like auto and various other parts of the market, which are now under some kind of pressure. Where is the risk to our market? That's very, very important. So there is a risk to our market in the form of reflecting what happens in the global market. So we are going to always have that overnight worry. So that is something that we will have to factor in. But my experience as far as this waking up worry, I call it wake up worry. You get up in the morning and you immediately switch on your phone and you see what happened to Dow and Nasdaq. In my view, wake up worry is always an opportunity. And that is something which we would like to turn into our collective favor. Now a bit about our investment philosophy and what the ithought way is. I had put out a tweet about an hour ago, which more or less, clearly tells you what we mean to do with the ithought way. And the PMS will also follow it strictly. We have created a suite of products where we have thought about what will work for so many people. It has to work for a large number of people. And the product should suit the risk appetite of all these people. Importantly, we are very, very clear that while we can also fit into these products, now I can be an investor in this product and my money will also be, best placed in these products. The product should not completely reflect what my risk appetite is. It's not about me. It's about what all of us can collectively invest in and profit from. So there has to be a collective consciousness in how products are curated. This does not in any way undermine any product, because the opportunity to create products in India is still very high. We are at a very nascent stage. The fact that we buy suboptimal, volatile solutions, right, of different platforms clearly shows that we need better products in India, right? We need to have products which suit different kinds of needs, different kind of investor. And our philosophy is to always create those products. So in product curation, we want to be unique and we want to custom manufacture products which will deliver results for a very long time. Like if you buy a Toyota, you're very, very comfortable owning a Toyota, whereas you're not going to be comfortable owning a Tata, right? You don't know when the vehicle will break down. So we want to have that kind of a resilient product engineering, which will basically be consistent and which can be reliable over a very long period of time. So the focus will be always long term. We still want to go and buy parts of the market which others don't want to buy because they give the better returns. Otherwise, we will all be mirroring the indices, or we'll have to buy more risk to make the same return. Whereas our concept is to try and do a few non-consistent things which allow us to do value investing and still create the return of growth investing. That's the idea. Now, why do we need to do this? We need to do this so that the investors are at lower risk when the markets become extremely volatile. And by being at a lower risk when the markets are extremely volatile, you get the comfort to do the 10% extra investing. You put that extra money when others are very, very scared. And that money gives you the outlier returns, while your regular investments always keep you up to the market, right? So you're always as good as the market. And whatever you do in extreme situation, take you ahead of the market. So this is broadly the concept behind doing a bit of non-consensus investing when nobody wants to do it. Naturally, such an approach has to be bottom up. So we need to buy something when it's really kind of out of favor and turning. But that does not mean that we'll buy things just when things start to look great, because the valuation is always ahead of event. So when things start looking great, people would have already bought into it and bumped valuations up. So we need to buy it a little ahead. So you have to be bottom up. You have to be early into some of these opportunities, and you need to be willing to put the money when there is no consensus. But in all this, we want high focus on risk management. Now, this may sound a little of a paradox, but it's possible. How do we do that? We don't invest in businesses which have leverage. We take risk where, when the risk recedes, the return flows straight to us. It does not go to a lender. It does not go into other stakeholders, right? And we have not paid too much. So in that sense, the risk management is very nicely done in the product curation stage first and in the process management stage on a continuous basis. So there are two types of risk management that happen in all our products. And this helps us to deliver a superior investment experience for investors over very long periods of time. And we have done this earlier, and that is what we have productized now. So the product is not something we woke up one morning and decided this is it. It's something which we have practiced and then we have productized. Lastly, we don't trade, we don't speculate, we don't do IPO, we don't do follow-on offers, no F&O. So we are not going to chase momentum. We are not going to do things to show that we can generate very, very high returns, because when you do that, you can also generate very, very low returns, and we want neither for you. So we want a more normalized investment experience where when markets fall, you're ready to do more and you're able to take advantage of that fall. And when markets rise, we are able to move a little bit of your money to safety or into a area where nobody wants to invest. So it's like a nice 360-degree clock which keeps going, and we are always doing the right things depending upon where the needle is pointing. So we want to be people who invest when valuations are between 4 o'clock and 7 o'clock, and we want to be people who sell and reduce your risk when the valuations are showing between 11 o'clock and 2 o'clock on the clock. So you can understand how the investment process keeps working for you on a continuum. So that's how the ithought way, the core philosophy has been developed. Solitaire was our first product. We had done a lot of groundwork live for a long period of time. This is a product that has been tested in live market 10 years. We have done investing for 10 years in a portfolio, curated it, and then product testing. No back testing. None of our products carry back testing as evidentiary or as an investment argument to be placed before you. Everything is born out of real-time investment testing, because I believe that only when you have practiced the process, you can sustainably do it for a long period of time, react exactly how you should in every possible situation, and tell the investor what he should do and how he should be a part of every opportunity. So if you don't get your feet wet, and if you have not practiced your craft for a long period of time, back testing will not take you far, especially when you are not well prepared for situations like we're seeing in the present. So that preparation can come only from real-time investing, and all our products are born out of that real-time investing. Now let's go to the next slide. So here I'm going to ask Balaji to take over, and he's going to take you through our core investment philosophy. Balaji is a key member of our team. He heads our research and he collaborates very closely with all our product ideas. Over to you, Balaji.
Thanks, Shyam. Good morning to all. Having established clearly the house philosophy and the fund philosophy, it's our time to see how we incorporate the fund philosophy into the stock selection. So there are 6 critical framework we use in terms of stock selection. The first one is strong leadership team. What we believe in is any sustainable wealth creation for a long time need organization with good leadership at the beginning. So we believe having good leadership team and core promoter holding is the key. With a good leadership team, what we also look forward is the leadership status of the company in their particular industry. Why leadership status is very important is in a given a 3 to 4 years, if you have to see every sector, the top 3 to top 4 players makes a lot of money. So we want to clearly focus on the portfolio into the leaders. Having seen the good promoter ownership and leaders, we look for the character of growth, because when we buy into equity, growth is the foremost character which creates value over the medium term. Good governance is the must. So it's a binary decision. If we find governance is not up to the standard, we give a pass. So there is no two question about it. Finally, given all the construct of good leadership, growth, and a good family structure, it comes with a good financial discipline which leads to low leverage. And finally, if you have a great company, the good investment is all about buying great business at a valuation which is reasonable. So we are as a house strongly believe you don't pay a $1 for a dollar. Instead, you should try to pay 40 to 60 cents to a dollar, which gives you margin of safety in the medium term. So having established what we look into the portfolio, let us share some insights into what we have given, because the proof of the pudding always we believe in eating, right? So let's see some portfolio quants. Have we done what we have committed to our existing shareholders? Move to the next slide. So this is a very interesting slide which denotes two things. One, we have 30 stocks in our existing portfolio in Solitaire. And if you see carefully, out of 30, 25 stocks are in number 1 in the respective industry. Only 3 stocks are number 2, and there are 2 stocks in number 3. Broadly, we can sum it up. All our 30 portfolio companies are either number 1, number 2, or number 3. And we don't have any position in number 4, 5, and 6, which clearly demonstrates what we say and what we deliver. And to some, if you have to see on the right-hand side, there is a small table which also reflects a true multi-cap style where we have close to 10 stocks in large cap and 14 stocks in small cap and 6 in mid cap. So in the last 1 year, as we saw volatility is continued to rise, we moved a lot of capital into large cap, which is now showing a lot of resilience in the portfolio. If you have to see the next slide, the low leverage, right, which we believe is a very critical ingredient on a medium term perspective. Why? The moment a company doesn't have leverage, the management can take decisions which is really good for a shareholder from a medium to long term point. And if you have to see our portfolio, we have 25 stocks out of 30 which doesn't have even a single debt and a lot of cash sitting in. And there are 5 companies has some bit of a debt. So what it brings in for us as a capital allocator is these are companies take decision day in, day out, not worried about the next interest payment or the debt payment. And as Shyam told, last 2 years been pretty tough from the macro point, right from COVID. Then we had a sharp uptick in the markets. Now with rising inflation and geopolitical tension, having a portfolio of so resilient balance sheet makes the management to take continues to invest in the future development, which will be very positive for the shareholders. And if you have to move to the next subsequent slides, dividend payout. So the third critical ingredient we look at when we invest is dividend. Why dividends are very critical is at the end of the day, when you generate sales, sales has to lead to profit, profit to cash flow, and cash flow to dividend. Dividends are very real. It gives you a lot of clarity about the longevity of the company. And if you have to see, our portfolio, 37% of the portfolio gives dividend payout of more than 50%. So give you an example, a company delivers 100 crores of profit. This 37% of the company gives more than 50%, which is 50 crores of profit to the dividend, which also clearly reflects the companies are well run, they are able to generate cash and able to pay back. In an environment where a lot of loss-making companies are getting listed, we are very clearly focused on companies which have a sustainable business and started delivering dividends in the long term. Having seen the three critical quant of debt to equity, dividend payout ratio, let's see a portfolio management is all about picking right companies. That's part one. The part two is all about how do you bring every company into a portfolio which can deliver a sustainable return. So in the next subsequent slides talks about how did we brought all these companies tied to philosophy of ithought and Solitaire and now into the portfolio, which is the most important thing from a investor point of view. Active bet. What is an active bet? Active bet is typically the bet where the fund managers are allocating into the stock which is not part of the index. So when you come into an active fund like Solitaire, our main objective is to find ideas which can create sustainable wealth. And if you have to look evidence, these are 4-quarter evidence, which is Q1 21, Q3 21, Q1 22, and Q3 22. Consistently, more than 80 to 90% of our portfolio is completely active bet. So what does it bring to a shareholder is, irrespective of market movement, our position is all about individual stock, which we believe in the medium term can create sustainable wealth, and we buy into it. So we don't look into the benchmark. We don't have any banks. So just to put in perspective, in Nifty, the entire banking exposure is 35%, and NSE 500 is roughly between 20 to 25%. We don't have a single bank in Solitaire. The entire portfolio is a good mix of financials, which is non-lending, and auto, and bit of industrials. Moving on to the next slide. Having seen the active bet, which is a critical measure of how much the portfolio manager is playing actively, the next immediate thing to look at is risk. Because in the last 2 years, what we have predominantly seen is the returns. It's been a one-way street post-COVID. Off late, some volatility have hit. But as a house, we clearly believe portfolio management is all about managing risk, because the returns are delivered by the management and by the corporations. We are here, primary job is to allocate capital wisely and manage the risk in a medium term. So one of the way to look at risk is how much position weight we end up giving to single stock. I'll just run through how Nifty is structured, which gives you a good idea about how our portfolios are designed. If you have to see single stock exposure more than 10% in Nifty, there is one stock. There are two stocks between 7 to 10, and there are 25 stocks are less than one. So broadly, the index has only two things. Either you have stocks with very high weightage, and either you have stocks only the name is given and not the weightage, right? So very few stocks actually matters to the index return point of view. But what we believe is, if we have a 20 to 35 stocks of a portfolio, every single stock should have a meaningful representation, and that is evident from the weightage. Our sweet spot is between 3 to 5. Ideally, we end up taking a 3% position in an idea we are convinced. Anything less than 3 is either an idea which we started buying into it, where gradually we move into 3 to 5, or an idea we are exiting. So 3 to 5 is our very core holding, and few of the ideas where we think clear execution is in there in next 3 to 4 years, and valuations are very attractive, we end up owning 5 to 7. And ideally, we generally don't own more than 10% as part of the risk metric. And less than 1 is also idea, basically in the way of exiting or just introduce. So from a risk management point of view, it is not a single trick pony about picking one winner and making the performance. Our entire thought process is have 20 to 25 well-run stocks into the portfolio, and with a meaningful weight between 3 to 5 as a median exposure. Moving on to the next. Our belief in the long-term success of a portfolio is, having looked at the philosophy and the way we select and the way we build, there are two critical things important from a long-term success. First, riding the winner. Out of a 2025, the winners will be like 5 to 10% or 5 to 10 stocks in the long term. Riding winner is very, very critical, because they are the one who will give us an above average return, and also selling loser dispassionately. So one of the critical issue happens in a portfolio is there could be a holding bias. Since a lot of time is invested into a stock, there is always going to be a resistance about why to sell. But I think in the long term, if anyone can judiciously practice these two philosophy of riding the winner consistently and selling the loser, not from the price action alone, but from the fundamentals. So if the fundamental of the company continue to do good in the medium term, you can expect from us to hold the stock for a very long time. And I'll share some example of how, as a house, we were able to ride a couple of story. This is one such stock. This was an early stock into our portfolio. We bought our intended position between 50 to 100, given the range. It's a very niche IT company on the EV space and autonomous space. We are early into the trade. The stock went from 50 to 125, saw a big drawdown to 94, which looks very small in the graph, but it's more than a 30% drawdown, and then gradually start moving up as the fundamentals improved. As the market started looking at this company better and better, and as the valuation reached a threshold, we started trimming the stock at around about 280 to 300. Then we got a very positive results and a global tie-up which pushed the stock to 600. So from a 50 to 100, we held the stock for a 500 to 600 very comfortably. But at the point of peak, we clearly saw the valuation have reached in such an extent where the forward-looking return was not great, and we have taken a call to reduce it. So this is a classic evidence about two things. One, as a house, as long as fundamentals are good, you can expect us to hold the stock for a very long time. And that's what it clearly demonstrates with this example. Moving on to the next, as I told, ability to hold is one, which we have clearly demonstrated. At the same time, if we think the company thesis have changed, it is always good to exit. And this is one such story where we think, even though technically we made money out of the stock, our thesis got changed overnight and we have taken a decision. So we bought around about 220 to 240. This is in liquid logistics company, went to 340. Then came a big corporate action overnight, which we clearly thought was not right. We even questioned the management and were not convinced with the way they responded. So we clearly took a decision about, we came with certain assumption in the company, and then the corporate action. It was not consistent with our thinking, so we thought it's good to exit. Luckily, obviously, the stock had fell. But the big takeaway for all our prospective investors is we don't shy away from taking decision. We have invested time, but what we thought is it's good when thesis get changed, we move on. So what you can expect from us is in the long medium term is if the company fundamentals are continue to do good, you will see the stock will be in the portfolio for a very long time. At the same time, if there is a big change and we are not comfortable as a house, we will not shy away from taking decision. So that's a key message from this slide. Moving on to next, having seen the philosophy, the way we construct, and what the this one, how does our portfolio will look like in the 3 to 4 year times, right? We will definitely should see a few big winners. That's going to create a lot of money, but definitely there will be a lot of mid-wicket. We have to be patient because from this mid-wicket player is what we will get winners, right? Even the tech company was a mid-wicket stock. At some point, it become a big winner. So our idea is to have few big winners will happen, lot of optimum performers, and definitely you will also see in your portfolio few losers. But only price action doesn't determine a stock is a good or bad. In our belief, if the fundamental is deteriorating, we will sell. Otherwise, we will continue to hold. So this is how a client who was invested 3 years back are seeing today's portfolio. And I'm sure someone is coming today might end up looking at in the next 2 to 3 years point of view. Moving on to the next, how the fund is positioned, which is very critical. Having spoken about in length about the philosophy, the way we pick up stocks and way we construct, what to expect, because expectation is all about setting the right expectation. So in our belief, all investment is done to beat the inflation sustainably so that we create real wealth. In Solitaire, our objective is to attain anywhere between 700 to 900 basis point in the medium term. Obviously, right, forward-looking returns are very difficult to project, but our intent when we take decision is, can we attain above average return in the medium term? Moving on to the next. How do we look at anchoring our long-term return expectation? As Shyam started with the first slide, where our average return is 10.24 in Sensex. A similar profile of this. This is our ithought Nifty vantage point. every investor comes at different point in time and their experience to the market is very different. So I'll just give you two examples of how different experience in the beginning, but in the end, it could be a little more closer. So if you have to see 2008 investor, the starting year was very, very tough with a minus 52%. But over a period, if you have to see, the returns have delivered between 8 to 9% in the long term. The same investor who have come in 2009 have got 13% in the long term. But any investor who have come before 2000, the long-term return, which is in the right-hand side, if you have to see, it's between 10 to 12. I think over a long term, India has delivered 10 to 12, given when is your entry. So a consistent belief is with inflation in India is around about 4 to 5. Any return between 12 to 15 is a very good return in the 3 to 4 year point of view. And what Nifty has delivered is also between 10 to 12. So with the right expectation, I think every investor, we can create a very happy experience in the investment field. Moving on to the next slide. Our performance, even though it's not a long track record, we have built a decent track record with since inception of 21.91% and last 1 year between 30.53. So our whole intent is to deliver sustainable return in the medium to long term. Moving on to the next slide, the fund is run by Shyam. And okay, before slide. Portfolio terms, minimum investment 50 lakhs, benchmark NSE 500, fee 1.5% per annum AUM on a daily average, charged quarterly. And typically single sector exposure, we don't do get into 55, it's more of a regulatory point of view. Our idea is to cap it 25-30 in a practical terms, and no single stock, as you have seen evidence, currently no single stock more than 10% also. The fund is run by Shyam, and I head the research. We have a 5-member team to support the on the ideation of the stock and to build the portfolio. And that's it. Go to Shyam, and we'll take any questions. Thanks for the opportunity.
Thank you, Balaji. We'll open the floor for questions. So we'll be happy to answer your questions. You can type in the. So what is the current AUM managed by Solitaire? Balaji, over to you.
It's 214 crores.
The losing stock name, the company which we sold out is Aegis Logistics.
Yeah.
See, in any product, there will be a fair share of stocks which you sell out and they didn't do that well. When you buy 25, it's normal for 2 or 3 or 4 to not do well. It doesn't matter actually. We have to only minimize the impact of that. That's a good question. Do you keep buying the same portfolio like a mutual fund at all price points? Certainly not. Most certainly not. If you give me 50 lakhs today's valuation, we have a stock universe. We'll try to bring in all the stocks, but if a stock is very expensive, I won't chase it. So the portfolio will be created to each market context within the broad portfolio principles and within what we believe are a reasonable valuation bands. So why mutual fund? Most PMSs also do cyclo-styling. You give 50 lakhs, they're just morning go in and buy the same portfolio. We don't do that. We invest only gradually. That is the next point. Dividend will be given back to the investor or it will be reinvested. All dividend will be reinvested. All dividend will be reinvested. Dividend is not given to the investor. How do you evaluate the quality of leadership management? Balaji, I'll let you answer that.
So from a leadership point of view, what the biggest thing is capital allocation. So what we look at is every single company we invest typically will have a 10 to 20 years track record. So an easy way to assess a management quality is, are they saying and what they're doing is consistent? And if at all we find that evidence is true, we'll be very happy with the management to partner. That's point number one. Point number two is with the consistency on the capital allocation, how do they treat minority shareholder, both from disclosure level and rewarding the shareholder? So these are the few things which you can explicitly monitor. Implicitly is how do they take care of the culture of the organization, seeing the vision and being a forefront in the particular industry. That is subjective, but the objectively is capital allocation will clearly give you enough evidence about is this management is worth to partner in the medium to long term.
What is the percentage of small, large and mid cap? You already given that. You can just go back to that slide and show it again. The percentage of Ganesh, you can move the slide, percentage of small, large, and mid cap. You can just keep that slide open for people to see in the portfolio. You can put that slide up there. And then how does the deployment of funds work for a new investor? See, suppose somebody gives me 50 lakhs today, maybe I will be able to invest about 70% today. The balance I'll invest at the stock level when the stock falls. So it'll be like I buy a personal portfolio the same way only. When I find the valuation is attractive, I'll buy. I'll probably put orders and keep every day. Or when the stock falls, like we had this correction 2 days ago, which gave a very nice, again, one more chance to buy 2-3 days ago before the market started rallying. So on that day, we'll tend to buy more. So typically on the fall days, we tend to exhaust the cash. So that is how deployment. So immediately the client has to give us money because it will take 2 days again to buy. Sometimes we may anticipate a fall. So in anticipation also, we will tell people to give us money so that on the day the markets fall the most, we are ready with the money to buy. So it's like you are lying in wait, your net is cast, and when it's the right time, you just roll the net up. It's like that. What if a company is 100% growth stock, but there is some negligible corporate governance issue? Will you consider those stocks? See, negligible is a very judgmental and subjective word. See, if we feel that the issue will hurt us as investors, we have to stay out. Even in doubt, you have to sell actually. You cannot, what I have seen is that you cannot even give the benefit of doubt because the promoter has created that doubt, knowing fully well that it is a risk. That itself is a message to us actually.
Shyam, can I just add a point?
Yeah, please.
This is a very important question because everyone says governance is something which we look at. So as a house, right, we typically invest 40 to 50 days in terms of doing a deep work on a company. But there was recently one company which is into, which will be a big beneficiary of a hydrogen economy. But what we figured out is from the exchange filing and all that stuff, there is definitely a governance issue in the past. And clearly we said, okay, even the forward-looking returns are very good, like what you have also projected, right, in terms of very attractive proposition. But it's a binary decision. It's not a decision where we say, okay, if it is governance, I'll take a 2%. No, either it is yes or a no. In this, clearly, it is a no.
So actually, there could be a situation where the governance deteriorates or something happens which makes the governance questionable after we buy. Our response to that has been we got out, and we have been right every time we sold actually. So to err on the side of caution, see, to make very decent investment returns, I don't think we should take undue risks in the area of governance. There is no need to do it because better companies you get available at a lower valuation, right? So that opportunity is always there. What's the earnings outlook for the next couple of years for the broader market? It all depends on GDP growth. I think that this year is going to be decent from what it looks like. Earnings outlook looks very decent. Our investing is as such quite defensive. We don't have banks, so we don't have credit as much in our portfolio. We have a lot of insurance and other platforms in financials. Mostly, I think that inflation can help some of the businesses which we have invested in. They're able to either price better or their end customers are going to do better. So there is going to be operating leverage in the form of better utilization and stuff like that. So the earnings outlook, I think for the next 2 years should be decent. Inflation in some parts of the market may be high, but I think that we are reasonably well positioned to benefit from inflation than be hurt by it. So it will also give us an opportunity to buy inflation affected businesses which will do well over a longer period of time. So in that sense, our positioning is reasonable and we feel quite positive about the earnings outlook of our portfolio. The broader market should also see decent earnings growth. It should see decent earnings growth. If you look at the Nifty projections, Balaji, can you briefly talk about the Nifty earnings consensus?
Yes. So for the next year, the overall projection is close to 17% growth, primarily coming from banks, which is where the credit growth is picking up. And as I told earlier, the weightage is 35%. IT prospects is very brilliant. I think in the last decade, now IT is well positioned with an 18% weightage in the index. The biggest disappointment will come from auto and FMCG. So broadly, index is expected to 17 to 18% for the next year. From our portfolio point of view, I like to reiterate that when the company's balance sheet are close to zero, I mean, they don't have a debt, very well funded companies, and as the economy is going to come back post the COVID, These are the companies which can invest into the growth projects and capitalize. So it's all about actually the individual portfolio. Our portfolios are well positioned to keep not only growing for the next year, we strongly believe next 3-4 years we're going to have a strong growth trajectory in our portfolio choice. And it's all about executing and buying at the right price.
Okay, now to the next question. I'll answer this. So will you beat the benchmark and do better than that? Can you compare MF charges and PMS charges? So good, both are very good questions. To me, it's more important how much I beat inflation by, because that is what is going to give me my purchasing power. So suppose inflation is 5% and I am doing 15. I think that's a phenomenal performance. Suppose inflation is 7.5% and I am doing 15. I think that the performance of the lower inflation beat, which is a wider beat, is better than the higher inflation beat. Now let's come to the index. In my opinion, index basically historically, if you look at the long history, it's done 10%, 10.5%. Now it should have gone down further because I'm telling at the peak it did 10%. When the recent peak, when you calculated, I think the XIRR was 10% over a very long period of time. So that beat on inflation has always been between 2.5% and 5% and not what people are thinking it is. So taking these last 2 years is a wrong indicator, in my opinion. That is why people have gone wrong this year in index investing, and next year also I expect people to go wrong with index investing. So these near-term biases we should take out. I think that we should measure how much we beat inflation by. If we beat inflation by what we are aspiring to beat, I think we need not even worry about the benchmark. I think you need not even think about it. I'll give it to you in writing. If you beat inflation by the kind of beat that we want to beat over 5-10 years, irrelevant benchmark. Benchmarking will become irrelevant. That's the point I want to make. With respect to charges, now the whole idea of Solitaire was to give people who invest 50 lakhs plus a way superior investment experience over mutual funds at a cost which is comparable or cheaper. Now today, look at where people are going and putting all the money. They're putting it in small funds which are having a low AUM because those are able to move their money faster. So sub 2000 crore is where all the money is going in. There, if you see, your cost is about 2.5%. That is 250 basis points is the total expense ratio. Most of these funds are charging because they are trying to make a better return, which is probably comparable with ours. Our idea is to restrict it to 150 and give the same or better experience with a lower risk taking. See, that's the most important thing. I am not taking risk the way these mutual funds are taking. And I believe that we will do better than what they do. And evidence is clearly showing that we are doing better than what they have done in the last 2.5 years. The whole idea of Solitaire is to allow the HNIs to choose much better than they do with the mutual fund ecosystem and to keep scaling up in one place so that they are having one flexi multi-cap portfolio where they can always be sure that their mix is right. And they are also seeking opportunity. So you're not restricted by what SEBI tells a flexi cap fund should do or a multi-cap fund should do. I can go 80% large cap, I can go 30% large cap. It depends on the opportunity. And it gives me the bandwidth to get in opportunities which will reward you better. So in that sense, our fees are lower than the mutual funds. And they are likely to do better than mutual funds, and they have done better also. Now, with respect to PMS charges, traditionally PMS charges are they are coming from two sources of income. One is a fixed fee, and other is a variable fee. Now, what we have done is we have restricted our fees in Solitaire to a fixed fee. There is no variable fee. So let's say we do very well in 1 year and we make 40%. That year you are still paying only 1.5%. Next year, let's say we do 10%. You will pay only 1.5%. Now, even in most of the PMSs, what people don't compare is that, let's say 2 PMSs do 40% return in the same year. One is Solitaire, you pay only 1.5%. One is some other product X, right? There you pay 1.5 or 2% fixed fee, and you also pay above a hurdle rate, let us say 10%. On the 30%, you will pay another 20%, which is 6%. So you end up paying 8% fees. So the net fees you are paying is in the region of at least 4 to 5 times more than what fees you are paying in Solitaire. And the next year you will again pay the same fees you are paying us also to them. So that is the differentiator in fees between Solitaire and generally comparable PMSs. While arriving at the right valuation, how much significance due to intangible assets like organizational culture, brand equity, IPs, patent? In my opinion, I am not paying for that generally. Like, that's what the investor gets in as returns. If I pay for it when I buy, then the investor is going to get less. The less I pay for intangibles, the more the investor is going to make returns. So I'd rather not pay too much for that. That's how I would look at it. If I have to factor in everything into the valuation, then I am looking for a justification to invest in the company beyond what the numbers tell. I'm not quite happy doing that because the upside is going to be limited. Yeah, this is about different valuation thresholds to buy and hold. That's absolutely right. We will buy only up to a certain threshold valuation, but we may hold even when the valuation goes slightly higher. We will still continue to hold, but we won't buy. That question is correct. So the reason is we don't want to overpay. It's very simple. When we don't overpay, we protect the investor from a drawdown. That's the best way to protect you from the drawdown. And when a drawdown happens, I will ask you for money and invest into the very same stock if my conviction holds, which normally does. So when you enter is very, very important. There is no point in showing high returns and then taking a lot of money from a lot of people and then showing suboptimal returns. If you look at all the funds which have attracted huge cash during 2021 and second half of 2020, you will see that at the individual portfolio level, performance is not up to the mark, right? We have also grown our AUM significantly during this phase, and we are still managing to maintain those 1-year returns. The 1-year return is a story which is really representative of what kind of investment management we have done, because the people who have come even 1 year ago are doing better, way better than the benchmark and probably comparable products. But again, tomorrow is another day. We are going to fight a future battle with the market and we have to keep working hard. No point in taking credit for whatever happened in the last 1 year or in the past. So I think that it's very important that the product takes care of the new investor just the same way or even with greater care than it has done for an older investor, because people who are invested early have already made their returns. People who are investing later have to be protected and carried carefully so that they also make a good return and get a very satisfying investment experience. So for every investor, it's very important, and the Solitaire process basically works that way. So every investor, every portfolio is important. Decision making is at the individual level and not at a overall level where we just cyclo-style or carbon copy portfolios. We don't do it. If we have 25-30 stocks, how can you get multi-bagger benefit? As the money will be very less in a stock which becomes multi-bagger. No, 3% is not a small number in any portfolio. Let's say we take it to 3 or 4% and it does, let's say 3x or 4x. You will make 10% profit just from one stock. In fact, we have done it in the last year. At least 2 or 3 stocks have done 4x, 3x. So that is how the returns will come. So actually the overall portfolio risk will be kept low. And the stock which we made money, let's say I bought at 200 and sold at 600, would have given him the bulk of the returns. So that is how money will be made. And there is no need to buy 10% in a multi-bagger. I think there is no need, because I think such risk taking will also cut the other way. Like, if something doesn't go right, then you have to get out of a 10% position. Very difficult. So you need to control your risk so that you make an overall investment performance. You give a very good investment experience and you give conviction to the investor to buy when the chips are down, when the market is trading lower. So you have to be helping the investor participate more and more. And when the investor participates more and more into opportunities when they are in his favor, I think investment performance will flow to that investor. I think an individual investor need not worry about what happens to the overall returns, because the game is in his hand. I'll give you an example. There are people in the Solitaire ecosystem who gave double. That is, if they're given 1 rupee, they're given 1 more rupee in the bottom of 2020. Okay. Now their return is way above this overall return. This overall return includes their return. It also includes the return of people who gave money in 2019 and didn't add. So it's an average, right? You have to understand that the return is an average. So the investor who can bring better behavior to his investing we'll always do better than this average. I can assure you that. Is 50 lakh SEBI regulation or mandate from ithought? It's SEBI regulated. SEBI has given a 50 lakh minimum. You take contra bets in Solitaire, a lot of them, but not leveraged companies. We don't buy in companies with high leverage. But we do take contra bets. Quite of our bets which have succeeded have been contra bets. Because the contra bet is what gives you a high return. We had used the phrase non-consensual investing in one of the earlier slides. A contra bet is non-consensual investing only. How does one do the tax treatment in terms of capital gains through a routine? Yeah, tax will be in your hands. You will have to pay the tax. Generally, we try to avoid trading, so the tax will be somewhat under control. Yeah, this is a good question. If Riddhi giving good returns, why will we choose Solitaire? End of the return makes a difference, doesn't it? It depends upon a risk appetite. So if you want a small cap portfolio only, then Solitaire is not for you. But if you want a multi-cap portfolio, then Solitaire is for you. Generally, what I am doing personally, and what I suggest is you create a pair of two products so that you can always invest in both according to the opportunity. So you're not restricted. And according to your risk appetite, you can always scale up the product which suits your risk appetite and which offers better opportunity also. That is how it is. How do you deal with value trap? If we take several years, we will get out. We will exit, as simple as that. We have exited quite a few. Can we allocate 50% each? Yes, that's a good allocation in my opinion to start with. And you can scale up. Suppose small cap falls all the more in the next 2 years. Then you can scale up more into the small cap space based on the opportunity. Suppose large cap falls more, or you can scale up and you're comfortable with investing in large cap, you can scale up a multi-cap approach like Solitaire. You can do both also. So a little bit here, a little bit there. There are clients of mine who have both portfolios who invest into both. So they do an allocation into one, some part into this and some part into that. We also guide them how it can be done. That is also done. So you can allocate between two portfolios, but you cannot do 50 lakhs into two portfolios. That is, you cannot do 25 lakhs into one and another. You have to do 50 lakhs into each. We are not taking a view that you can invest less. Each portfolio has to have minimum 50 lakhs. You can bring incremental amounts whenever you want. Minimum investment is 50 lakhs. You can bring in incremental amounts whenever you want. By bringing in regularly at regular intervals, you are able to participate in every dip. Like every week, we find some stock where you can buy a 0.5%, 1%. So it always gives us the opportunity to add more when the chips are down. So that is the differentiator. And the money goes into that specific script. It doesn't go into all the script. Let's say you're given 50 lakhs and you give 2 lakhs and more. I don't invest it in this portfolio on a pro rata basis. Wherever I think valuation is cheap and my allocation is still low, I'll go and increase that particular script. It will not be at a macro level. Sometimes you would include a new script which is not there in your portfolio. We'll buy it at the right valuation. So that is how the benefits accrue when you give more money. There are advantages like that. The disadvantage is if you give only once incremental money and you don't add at all, there is a problem. Those who invest regularly generally don't have disadvantages, they have more benefits. Yes, there will be regular communication on the incremental amounts. Our people will keep talking to you, telling you it's a good time to invest. What is the benefit? We'll go with PMS rather than mutual fund. The benefit is that your portfolio will be unique. It's not a general portfolio you share with thousands of people. If you are able to give money at the right time, your portfolio will buy the best stocks at that time rather than generally buy all the stocks. So that is the difference. So whatever is really cheap, we will buy at that time and not do a carbon copy type of investing where you buy the same stocks in a particular proportion. Can I monitor the performance? You can monitor. Once a month, you will get your NAVs, so you will know your portfolio. You can do that. But I don't suggest monitoring beyond 1 or 3 months. It's really not going to help you. And somebody is always going to give you the feedback on what you can do with the portfolio. Yes, the minimum amount of 50 lakhs has to be one time. Above that, you can do even in smaller tranches, 2 lakhs, 5 lakhs, whatever you can keep adding. So the first tranche has to be 50 lakhs to start a PMS. Without 50 lakhs, the custodian will not start the PMS. Balaji, you want to say something on this?
No, that's it. I mean, yes.
With manufacturing becoming important, how much do you consider for R&D or future potential in this aspect? We are having a very manufacturing heavy portfolio actually at the moment. We are betting on companies which will benefit from manufacturing. So that's how we are managing this opportunity. Who are the target audience of this PMS by Solitaire? I mean the PMS target for retirees or those who approach retirement with a value approach? No, we are targeting anyone who wants a very strong equity portfolio, which is balanced between the different teams and which doesn't have the risk of leveraged companies with borrowings, and who will be very comfortable to keep on adding money and keeping all his investments in a very, very safe zone of stocks. So, and who wants decent growth. So we want this to be useful for investors over a long period of times. It could be somebody who has retired, who is approaching retirement, or just somebody who wants to build a pension corpus. Let's say you are 25, 30, you have your ESOPs in some company. You want to sell and put on 50 lakhs away for your retirement. It's a great start. Later, when you keep making money, you can keep on adding and you can build your own pension fund, because if you're going to do this investing in this philosophy for 20, 30 years, it will be a lot of money built at a very moderate cost, customized, because when you give money, we buy the stocks which are most attractive at that moment. So your portfolio can be better than the average portfolio of the peer PMSs, and it can be better than the benchmarks or the mutual funds as well. So in that sense, you will be getting the rewards for showing better investment temperament in tougher times, and that reward will be earned by you for with a moderate cost. So in that sense, this is actually ours is cheaper than most pension funds also. What our product is cheaper than even pension products which are sold to you by different banks. So this product can actually solve a lot of genuine real needs because its zone of investment is very conservative, it's correct, and its investment process is also very measured. So it can give you a better result than any of the pension products as well. What will be the tentative tax incidence approximately based on our churn? It will be based on the stock merits. So we are not going to aim any churn rate, or we are not going, if there is no need to churn, we won't churn. On a need to do basis only, churn will be done, and whatever tax arises will be a consequence of that. Do you think mis-selling of insurance companies will bite them at some point? At the end of the day, IRDA regulation, I think they will have to live with it. How many of you know that there was a capital protection product which was sold by mutual funds exclusively through the big foreign banks, right? The commission used to be between 5 and 7% in a mutual fund. It's just ridiculous actually upfront, because am I right, Balaji?
Yes.
So yeah, so those were the times when such things were allowed, but now such things are not allowed. So mis-selling has gone away. Similarly, in insurance also, it will be more and more trail driven, and that will basically reduce mis-selling, and IRDA will have to do it sometime or the other. But you also have to understand that the competitive intensity is moving money away from policies which are, non-participating. I mean, moving towards non-participating policies, away from participating policies. So market will move a lot towards that. So that will also do a little bit of cleanup. Currently, I don't have 50 lakhs. Do you manage? No, we don't. We cannot take in smaller sums. You'll have to go through the mutual fund route and then come when you've readied that money. That's the best way I would suggest. Balaji, this question is for you. How much days will research team take to complete research on stock? And presentation, you said investors can take risk on highly volatile time for better return. Can you elaborate how you do this?
Yes, Shyam. So it's a good question because it typically takes 30 to 60 days to do deep research. So our process is, a multi-layer. The first analyst identifies the stocks and discuss with me, and then once it's approved broadly, the first major work to be done is on the existing data, which is you go through the past annual reports. Typically 10 years of annual report has been rigorously analyzed in terms of to know how consistent they have been communicating and then delivering. Then if the con call transcript is there, minimum 5 years of con call transcript, which is close to 20 con call transcript have gone through. Once all these documents have been prepared and rigorously analyzed, we get to understand few things very clear. Is the management is consistent? Is the business is easy to understand? And is there a unit economics which is completely favorable in the medium term? Once everything is in place, then you go into the deep work in terms of putting pieces together in a format to understand what will drive the revenue, what will drive the margin, and where the valuation is standing either from the historical standpoint of view or an absolute standpoint of view. And once the committee approves the stock after a rigorous discussion, it gets into an investment pipe. So the beauty of the process is today we have close to 25 to 30 stocks in investment pipe, which is basically a stock which is waiting to come into a portfolio, like an IPL team where the players perform exceedingly well and they end up getting into the international league, right? So we clearly believe preparation is the key, and by this only any crisis comes. For us, it's very easy to see, okay, there is an investment pipe which is not currently into the portfolio, but can be potentially a candidate. And if valuation is favorable and good in terms of the growth prospect, it will come into portfolio. That's how we will capitalize on every market fall. Even during this fall, 3 to 4 ideas which we generated 2 years back is actually coming into the portfolio because the valuations are turning attractive in terms of stock levels.
Okay, I'm going to answer some of the questions quickly. What is your Nifty view? I think that Nifty is today a prisoner of flows. So I think that if flows are favorable, Nifty can go up. If flows are not favorable, Nifty cannot go up. Within the Nifty, I think they'll see a lot of churn. So the good side will always take care of the bad side. So I am not really too concerned about the Nifty. What I am concerned about is, are we able to capture the opportunities where we want to capture them at the right valuation? So that should be our intense focus. We are not allowed to invest in international markets. We don't invest in gold, in Solitaire. We don't invest through Solitaire. You can invest in gold separately through a mutual fund or something like that. And we invest in Solitaire, in equity, but in case we want to invest some cash later, we do have some liquid funds, liquid base through which we keep the funds in the interim period. We don't buy any other funds in Solitaire. And the top up frequency can be as you like, but I think that ideally about 5 to 6 times a year it will happen. So at least once a quarter. If the markets are higher that quarter, you can take your time, but when the markets come down, you need to rush your money. So collect your savings, gather them, and keep topping up in installments. Like people have topped up the last 1 week and we already deployed the money same day. So we don't wait. So top ups are very, very important. I think 5 to 6 top ups in a year will be ideal. So you can average it out as 1 per quarter and 2 other miscellaneous situations where you can add. So that will bring you to another 10 lakhs every year you keep adding, which could be your savings. And it will go into all the right stocks at the right time. Can you stagger, say 5 lakhs per month? You can keep 50 lakh in liquid, but spread over. No. See, the point is, if you're giving 50 lakhs today, we will see where we are comfortable investing. There we'll invest over a few days. The balance 30 lakhs, we will stagger and invest when the stock comes in our favor. It's not a monthly average. It's purely buying on merit. Suppose I feel a stock won't be available after some time, I will buy it quickly. Why should I wait? Because by waiting, I may miss out on the opportunity. When you expect auto and two-wheeler to recover, they will take some time. But when they recover, it will be a very strong recovery. I expect this year to be a year where electric vehicle market will seed itself and it will grow over the next 2 to 3 years. You will see a phenomenal growth in EVs over the next 5 years, especially in two-wheelers. Cars may be moderate. So I think that auto should recover the next 12 to 18 months. So there's no point waiting for that. You can invest now. FMCG bets are available in the. No, I think that you have to see how inflation plays out. Look for 1 or 2 more results before you make up your mind on FMCG. If you start now, how different the portfolio will look somewhat different. Some expensive stocks which have delivered for them will not be in your portfolio. We'll buy strictly according to where we see value. And if those expensive stocks come back again, we will gradually buy them. If they never come back to our zone of comfort, we will find some other stock which will do that same job of that successful company. So yes, portfolios will be somewhat different from those who are there from the beginning. Some 10, 20% will be different, but that doesn't mean anything else except that we are being careful in how much we pay to buy a stock for you. So we want to be conservative in how we buy. So we don't want to chase a company at any valuation. I think 50 lakhs is a good number to start, because see, eventually you have to go to $1 million. The aim of every PMS investor should be to go to $1 million, which is 7.5 crores. Out of that $1 million, 40 to 50% you should have contributed. Let's say 3 to 3.75 crores should be your money over a period of time. You can keep investing 10, 15 lakhs a year. Generally, people can do that. So over a period of time, they keep investing. In one cycle, the stock would have, the portfolio would have doubled. So it's like 1 rupee invested by you in one cycle becomes 2 rupees when the cycle has matured. Then again, you keep investing and that becomes a bigger number. So that's how you reach that magic figure. So you can even invest less and go to $1 million, provided you're willing to wait for 10, 12 years, right? Even a smaller sum can become that. The aim is to become really large in your portfolio size and to invest regularly to become big. That is the idea. I don't understand the second part on the regulation side. Do you think any movement in this benchmark getting reduced? No, there is no chance of reduction. I don't see PMS sizes getting reduced. No way. What is the average period? See, if you cannot invest for 5 years, I think you shouldn't invest in any PMS. You give 5 years time and you continue to invest when opportunities become more favorable. You cannot invest 10 lakhs per month in place of 50 lakhs. Regulation doesn't allow that. You can do 50 lakhs and over and above that, you can do whatever sum you want regularly. That is allowed. But minimum must be 50 lakhs to start. We will not buy Lever and Nestle at these valuations. I don't think it's going to create favorable returns for investors. We're very clear in that. We need them to be much cheaper to make returns for you. See, there's no use saying I have Lever and Nestle and Asian Paints in my portfolio and not making money. I've seen a generation of people who did that in Infosys from 2000. I'll tell you what they did. They sold all their Lever and Nestle and the Colgate and SmithKline in 2000 because they didn't own any. They didn't want tech stocks. So they sold this and bought Infosys in 2000 and waited for some 12, 13 years to get their money back. In the meantime, Levers and other things probably performed somewhat better. Some of the companies they sold actually turned out to be better, especially GlaxoSmithKline did very well. I remember that very clearly. So when you buy matters, great companies should also be bought at the right valuation. Today, probably auto companies are where I see good companies at very reasonable valuations. Yes, you are right, Mr. Malingam. First tranche must be 50 lakhs. Give us one example of non-consensus. We bought Linde India at 600 rupees. We bought Timken at 700-800 rupees. We were there till both stocks crossed 2000. And then we got out when consensus happened. I've given you 2 examples of that. Portfolio turnover is not very high. Balaji, can you give a number to that?
No, maybe we'll come back on that on specific number, but broadly, it's very low.
It's not been a worry, I can say that, because we don't trade, we know that. Apart from the 1.5% management fee, you have GST and you have custodial charges and brokerage. Brokerage is pretty low. It's lower than industry, I know that. And custodial charges is industry standard, all 3-4 bips maximum, maybe under 5 bips. See, the way you buy and invest, all these charges will become irrelevant because you're going to hold it for a long period of time, no churn. All that will work in your favor only. How do you identify? Prasanna wants to know how, considering how unpredictable the world is at the moment, how do you identify risk? Balaji, can you take that?
Yes, in our belief, the risk is like you have to divide the risk into 2 things: control the controllable, control the non-controllable. I think this COVID and war is non-controllable neither in our hand and none of our hand. But what is controllable is the management and the way they have taken decision. That's why I said it's very important to know the history of the company consistently. How did they take decision? Are they being conservatively financed? Once you know that this company is going to put their head down and continue to do their business, once this bad news phase out, you will see that the winner will be standing out. That's a way where in the long term you can manage the risk.
Okay, we don't invest in unlisted stocks or startups. Can a PMS also invest in MF? We can, but we don't do it in Solitaire. We don't do it. We have another product where we do it. It's called Sphere. For a newcomer, you invest all stocks and PMS is holding. No, only select stocks based on valuation. I've already said that. How many stocks in a portfolio? All the 30 companies you're working with. No, see, each portfolio will have 25, around 25 stocks out of the ecosystem of 30, 32. That's broadly what I think it will be. Money in RIA, can you move everything to Solitaire? RIA investments are made in certain thematic way to get a certain result. If you want to move to Solitaire, as you get those results, you can move money. That's my suggestion. So you keep selling and going to the other place. That is possible. We cannot do what PPFAs has done in a mutual fund, because I feel that today working with a slightly larger investor makes a lot of sense from a current scenario. PPFAs did it 10 years ago. And secondly, I think that the mutual funds is a space where we can give small investor equally good experience, because we can safely say that our level of investment research and how we ideate mutual fund in opportunities is way superior to what the industry or the banks offer. And we believe that using that research capability, we will be able to deliver a very, very good investor experience to small investor in mutual fund. We have done it over the last 11 years. We continue to do it. I'll give you a small example. During the recent metal crash, which happened, we bought mining funds, and then Russia happened. So you can understand. So I'm giving you a small example how mining fund, global fund. So today what has happened? All the mines are doing well. All metal prices went up. Our mining portfolio is up 15% in the last 1 month or something near about. Daily there are some movements. The point I'm trying to tell you is in mutual fund also wonders can be done. Don't underestimate mutual fund, because the industry doesn't understand mutual fund. When you go to direct option platforms, what they are offering you is mutual fund schemes which are advertised heavily by the mutual fund on the platform. So the platform takes advertisement fees in whatever form they want, and they place it before you. So you are not seeing the variety itself. So you are thinking that this is all there is to mutual fund. Not at all. Mutual fund has got phenomenal choice for a small investor. And we are having a PMS product called Sphere, which uses all these choices to create a solution. So that is the power of mutual fund. It is not understood because those who are explaining it themselves don't understand it. That's the problem. See, I have invested in Solitaire. The employees are not invested much in Solitaire because they are all young and growing, and they may not have the money to invest in it. But when they have the money, they will certainly invest. I have invested personally. So there is no question of organizations going bankrupt, because you have to understand that any RIA or PMS firm at any point in time has to have a net worth on any given day. Minimum net worth is there. So for RIA, it's 50 lakhs. For PMS, it's 5 crores. So you have to maintain that money. So to do this business, on any day, I must keep 5 crores aside and only do this business. So, and we are not allowed to borrow in these companies. So there's no question of any risk coming to the manager. So bankruptcy is something which cannot happen because we are not allowed to take risks on the money which is kept separately for capital adequacy. Like banks, there is a capital adequacy for all our companies. No, we will not include ETF and REIT in Solitaire. As of now, there are no plans. It's very difficult to predict what return you'll make over 5 years, but I will say that you will reasonably beat inflation, and we have given you that benchmark even in this presentation. Is Solitaire investing in PSU companies? We have one PSU company now. We had 2 earlier, we sold out 1. Now we have 1. We will add if we are convinced and if it falls within the criteria of the scheme. Yeah, if you say you are having over 50 lakhs, as your investments mature, we can keep it in liquid and then move it to Solitaire once it's crossed 50 lakhs amount. Because you should not lose out on the upside in your investment where you already invested money and time. You should get the best out of what you already own. Yeah, we will do a program for Sphere. The other charges are all there in our website. You can reach out to any one of my colleagues whom you are in touch with. They will give you all the charges. Yeah. The other products, we will do a separate session, or you can always reach out to our colleagues. They can personally give you a look into all the products. So thank you very much. And we really thank each and every one of you who have taken time on a Saturday to spend this time with us and to understand what we do in Solitaire. Solitaire has been created with a vision for a very, very long journey. And those who make this journey will definitely feel well rewarded, richly rewarded. Thank you very much for your support. Thank you.
Thank you. Thanks.